In this video, I want to talk about investment managers and mutual funds, what they are and what their business models are. And we're also going to talk about potential career options in the investment management industry. Let's say this is you and you've been working hard at your new job and you've saved up some money. You know if you deposit your money in the bank, you'll earn some interest on it. However, at the moment in 2018, in the UK, interest rates are very low. And you know, if you invest your money in stocks and bonds, you might stand to make a better return and have your money work harder for you. So you decide to make some investments. In the old days, you might have gone to a stockbroker. So you might have gone to a stockbroker. I've done him here with this little top hat. So maybe this is before. And then you would have told him what stocks and bonds you want to buy. And you would have gone to the financial markets or the stock exchange and buy stocks and some bonds as well. However, there's a problem with this model. Although you're very good at your day job, you don't have much experience in investments, and you don't have much time to learn, but you still want to do a good job. However, in the 1970s, a new financial innovation occurred. People realized that if they took their money and they kind of put it with everyone else's money, so they all took their collective savings and pooled it together in a big pot, as it were, or a large fund, what they could do is they could take a small percentage of that fund, say 1% of that fund, and they could use the money to pay an investment professional. Investment professional. And it would be her job to spend all day choosing the stocks and bonds on behalf of people, the best ones that she could find, on behalf of her kind of investors, people like you and I. And so in the 1970s, people realized this was a really good idea and a new wave of money managers emerged. So today we call this business model a mutual fund, and the investment professional, we call them an asset manager or portfolio manager, or PM for short. And they take your funds and they basically invest it in a large investment portfolio, or they create a large investment portfolio, and that is supposed to generate returns on your behalf. So to give you a sense of how much money is in this fund, or in these types of mutual funds, there's thousands of investors, and a small fund would have millions of dollars in there. But they could easily have billions of dollars. The last time I checked, one of the biggest fund managers in the world, or the biggest asset managers in the world, BlackRock, had around about $2.7 trillion of assets under management, or AUM, assets under management. If you add up the value of all stocks and bonds that they have in these funds, you would get the AUM, the assets under management. So 1%, it might sound small, but in the case of BlackRock, that would be on the order of tens of billions of dollars. So nowadays, instead of choosing financial securities to invest in and using stockbrokers, people tend to choose different types of mutual funds and investment managers. And these investment managers kind of come in all different kinds of flavors, or the funds come in different types of flavors. Some funds, they will focus solely on one particular asset class. Say they'll only invest in equities or they'll only invest in bonds. And some will focus on particular regions. Maybe there'll be a focus on emerging markets, MKT, short for markets. And some might focus on, just standard large cap US stocks. So maybe you invest in a large cap US stock fund. And these funds, they tend to have their own risk profile, or they each have a specific risk profile. And that's kind of what you base your investment choice on these days. Are you a risky person, or are you not a very risky person? Do you like taking risk or not? And usually younger people are encouraged to take more risk. I think the idea is that if something bad happens when you're young, you still have a little bit of time to recover. I wanted to mention a new style of investment management these days is something called quantitative investing. So quantitative quantitative managers, and they kind of take this scientific approach and they use mathematical models to choose the investments and stocks on your behalf. And that's becoming very popular these days. In London, you might see ads for Man Group or Winton Capital on the tube or something like that, or on a taxi going by. And these are new types of mutual funds that focus on quantitative investments. And these are funds that used to kind of operate as hedge funds, but have now grown into much larger mutual funds. If you apply to a graduate career in BlackRock, in investments, you might choose between alternative investments, equity investments, fixed income investments, so it's bonds, or you might go into a team which does all those assets combined, multi-asset strategies, or you might join their quantitative division. And then one of the last things I wanted to talk about was the vehicle funds use, or the setup a fund has. Funds usually are either open-ended or closed-ended, and I'll explain a little bit about what those are now, but we'll do later videos on this and in more depth. With an open-ended fund, essentially what happens is you take your money to the investment manager, and they use that money to increase the size of their portfolio, and in return you get shares in the fund. You can come back at any time and you can kind of redeem your money by giving back the shares. And what they will do is they'll liquidate some of their funds and they'll give you back the money. And then hopefully in the interim period, the fund's value has increased so you get more money back than you put in. So that's called an open-ended fund, as new shares can be created at any time. On the other hand, a closed-ended fund, this is like a normal corporation that you just buy and sell shares in, and often they're even traded on exchanges. Here, instead of making money by selling like a product or a service like a normal stock or a business that trades on the exchange, their sole revenue source is from their investment portfolio. So the value of their company is solely dependent usually on their investment portfolio. And it's called a closed-ended fund because no new shares are created when people make investments. There's a finite number of shares and people simply buy or sell those shares. Okay, so I hope that gives you a general sense of what's going on with mutual funds. See you in the next video.